Okay, so what we are going to do is we talk about leases, we talk about what we call leases, what is a component. Then we take maybe lessor accounting, we solve questions on it. We come to lessee accounting, we solve some questions on it. Then we come to sell and lease back, we talk about it and solve questions on it. Then we move on to reassessment, we talk about it, then we solve questions on it. So the first thing that we are going to do is we are looking at IFRS 16, which is leases. So the question is, what is the meaning of leases? That is the first thing that we have to look at. Definition of leases. So the first thing is we have to understand what we call, or what do we mean by a lease? What do we mean by a lease? Definition of a lease. What do you mean by a lease? You say, oh, I'm going to lease this asset from this person. What is the meaning of that? What do you mean by a lease? What is the meaning of a lease? Let's move on fast. What is the meaning of a lease? Ms. Jackson.
Sir,
Yes, please.
basically, it's a contract.
Okay.
It's a contract whereby the lessor give his a property or this property to a lessee.
Okay.
Yeah, so basically it's a contract between the lessor and the lessee.
Okay. So right now the next question is who is a lessor? Because me, I don't know. I don't even understand the lease in the first place. And now you are bringing a new term, lessor and lessee. So if you can help me with who the lessor is and who the lessee is.
The lessor is the person or the organization that own the assets.
Okay.
And the lessee, like the one who is taking possession of it for considerable number of years.
Okay. Okay. All right. That's very nice. Let's take another person, then we move on. Let's take a lady. I say a lady. Okay, we have ladies here and we have women here. Auntie Esinam.
Yes, hello.
Yes, please. A list.
Please, yes, which one is the question? Is it the difference between a lessor and lessee?
No. The list itself. The list itself.
I think okay, a lease is a contract between two people for access, so that one can have access and control over a certain asset for a certain period of time.
Okay.
That's what I'm thinking.
Okay. That is nice. That is nice. Okay. So if they see a lease basically refers to an agreement. An agreement between two independent individuals. Where one of them who is the lessor, one of them who is the legitimate owner of the asset. one of them who is the legitimate owner of the asset, agrees to give out its assets to the other person for a considerable amount, which is always the rent. So you have decided to give out your asset to someone, so the person will use it, and the person will pay something. That is a lease. The asset that you are going to give out, maybe the asset must be idle. You are not using it. So it's an asset that you are not using, and you need money. So what you do is that someone who needs the asset, you give the asset out to the person to use for a considerable amount. The person will be paying something small for the asset. Why am I saying two independent individuals? Two independent individuals. I'm saying that the agreement must be between two independent individuals. Why am I saying that? Because a parent can give out its asset to what? To a subsidiary. The subsidiary is part of the what? The parents. They are not two independent individuals. In that case, we are not going to use the IFRS 16 to account for what? The asset at the group level. We are going to use IAS 16, which is property, plant, and equipment. The asset is still within the group. So if you want to talk about lease, the agreement should be between two independent what? Individuals. People who are not related. So if it is between a parent is giving out an asset to the subsidiary, or the subsidiary is leasing an asset to the parents, at the group level, this asset will be accounted for using what? Property, plant, and equipment, not leases. That is why I'm saying that it should be between two independent what? Individuals. Two independent what? Individuals, or one party and a third party. There should be two independent what? Individuals. All right, that is all about lease. A lease is an agreement between two parties. One of them is called the lessor, which is the legitimate owner of the asset. That person will agree to give out its assets to the other party, which is the lessee, and the lessee will pay what? Some amount of what? Money, or a considerable amount for using the what? The asset. For using the asset. This agreement can be of two forms. We have two types of what? A lease. Two type of what? A lease. So let's move on to types of what? Types of leases. Okay. Or types of lease. Okay. Types of lease. Okay. So we have two types of lease, which we already know. The first one is what we call the operating lease. The operating lease. Okay. People are complaining about my writing. Let me write for operating lease. Finance lease. Okay, let's take the two. Our focus will not be on the operating list, but our focus is going to be on the finance list. The operating list and the finance list, what is the difference? Operating list. Let's take the operating list first. Okay, the operating list. The operating list. What is the difference? The operating list and finance list. What is the difference between the two? What is the major difference between the two? Are we there? Are we there?
Linus, we are here.
Yeah. What is the difference?
So let me try.
Okay.
For the operating lease, the lessee does not recognize the assets in his books.
Okay.
But the finance lease, it is recognized.
Okay.
Lessee recognize the assets in his books.
Okay. 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 That's nice. That is nice. All right. Okay. You see, if you come to lease, we call something right of use. Right of use. The right of use is what? The asset. I'm the legitimate owner of the assets. So what I will do is that I have to give you the right to use the assets. So if I'm taking amount of money for it, means that for that period, I'm not going to be using the assets. So you are giving money to have access to the right to use the assets. So if you give me money, it means I'll give the asset to you to use. So for the operating list, there will be a right of use. Maybe you are a business person and you want to rent a store. So the person will give the store to you and you pay. So the person has given you the right to use the store. How do you get a right to use the store? You get a right by paying for the what? For the rent. So for operating list, you have the right of use. All right. You have the right of use, which we use the ROU. You are going to have the right of use. But this right of use, what will happen? If you get the store, you have to do painting. Maybe the store is not complete. You have to do painting. You have to do other stuff. These other stuff that you are going to do to bring the asset to a condition that it will be ready for use, it is the lessor that is going to do that. It is the legitimate owner who is going to do that. When there is an issue with the store maintenance and those things, the lessor will take responsibility of that. If the asset got damaged, the lessor is the person who is going to replace the what? The asset. So if you come to operating list, although you are going to obtain the right of use, the right of use will be obtained when you pay for the monthly rentals or the yearly rentals. But if you come to issues with maintenance, if you come to operating list, the maintenance, possession, control, the risks and everything associated with the asset still lies with the what? The lessor. When the asset develop a fault, it is the lessor who incur the cost of maintenance. Insurance, it is the lessor who is going to incur the cost of insurance. When the asset got missing, it is the lessor who is going to what? Replace the asset for you. So the only thing is that you are just going to use the asset. Anything concerning the asset, you are not going to incur the cost. That is what we call the operating list. And for this one, since possession, control, risks associated with the asset are not passed to you, the lessee, you have no right to recognize the asset. You have no right to recognize the asset. So if you come to operating list, if the amount that you are paying every year is 6,000, whenever you use the asset and you pay this amount, you just send it straight to what? Profit or loss. In the statement of financial position, the only amount that you are going to recognize is the owings that you're having with the lessor or the advance payment that you have made, which will either be a current liability or a current asset. So with the operating list, the control, possession, and all those things associated with the asset still lies with the what? With the legitimate owner. But let's come to the finance list. And the operating list, in the operating list, you can take the operating list over maybe the entire life of the asset. The year doesn't matter. You can take operating list for 20 years. The year doesn't matter. So if you see, they say that the person have leased the asset for 20 years. Don't say maybe the person is leasing the asset over or more than half of the useful life of the asset. So it's a finance list. No, that is not an indicator of a finance list. Finance list, the right of use is being granted, possession, risks, maintenance, insurance of the asset has been passed to what? To the lessee. So if the asset got missing, it is the lessee who is going to replace the asset himself, not the lessor. So if you have a lease where you are going to pay rent, maintenance of the asset is in your hands, Insurance of the asset is in your hands. When the asset got missing, you are going to replace it. We call that particular arrangement or a lease as a finance lease. So within the finance period or within the lease period, it means that it is as if you are the legitimate owner of the asset, because whatever happens to the asset, you are going to take responsibility of that. So in that case, within the lease period, you assume to be the legitimate owner of the asset because you are doing everything on the assets. So in that case, you have to recognize the asset within the lease period. So this is the difference between the two. Operating lease, you have the right of use, but maintenance, risks, and those things is still with the legitimate owner. But if you come to finance lease, you have the right of use, maintenance, risks, possession, control, all those things are being transferred to you, the lessee. So in that case, you assume that you are the owner of the asset within the lease period. All right. Let's look at another. Let's look at. So now we know the difference between the two. Our focus will not be on the operating list. We are going to take the operating list out of that. We are going to focus on the finance list. So we say that we have two parties to a list. We have two parties to a list. The first one is the legitimate owner of the asset, who is the lessor, and we also have the second person who is the person who is going to use the asset, which is the lessee. So these two people or these two individuals might be business persons. They might have their own business or they might be into their own business. So what they will do is that they are going to keep records of their own what? Business transactions. So it means that the lessor will also be keeping records of what is happening, and the lessee will also be keeping records of what is happening. So if you are taking an asset from me, how do I account for it? You that you are taking the asset, how do you also account for that? So we are going to look at the lessor accounting and also the lessee accounting. So let's start with the lessor accounting first. So we have the lessor accounting. How would a legitimate owner account for what? The lease. And the lease that we are talking about over here is a finance lease. It's a finance lease. Okay. You are giving an asset to me to use for a certain amount, but you are telling me that if something happens to the asset, I'm the one who is going to bear the cost. It is as if you are giving the asset to me or you have transferred ownership of the asset to me within that period. So what are you going to do? The asset is in your books and you are now giving the asset to me to use. And you are saying that whatever happens to the asset, I'm going to take responsibility of it. It means that the asset is no longer your own. So the first thing that the lessor has to do is to de-recognize the asset. Is to de-recognize the assets. So de-recognizing of an asset. If you say you want to de-recognize, it means that the asset will not appear in the books of the what? Of the lessor again, because it is as if he has passed the asset to me. The only thing that indicates ownership is where you have control, you have possession, you incur the cost of maintenance, cost of insurance on the asset. In this case, you are giving all these things to a third party. So the asset is no longer your own within the lease period. The asset is no longer your own within the lease period. So the lessor has to de-recognize the asset and the lessee must recognize that particular asset. So the asset might be de-recognized at carrying value or fair value. It depends on the what? The model that the lessor is using to account for that particular asset. The lessor can be using cost model or revaluation model. So at the date of the lease, the asset.
Hello, Larry.
Yes, Inia.
Sorry, I want to know what is breaking. I don't know what is only my end or is for everybody.
Really?
It's your end.
It's general.
No, it's your end.
It's your end.
All right, thank you.
Because I know that today my network is very stable.
I'm also experiencing the same one. It's
And then
broken.
the two of you to join forces and try to see how you can go about it. All right, but don't worry. The whatever be the case, the recording will be there. Okay. So the lessor must recognize the assets either at carrying value or at fair value, depending on the model that they are using to account for the PPE. Okay. You are going to de-recognize the assets. Okay. And the lessee is going to make payments. Is going to pay rent tax for the assets. So let's assume that the money that the lessee will be paying every year is 6,000. This can be either be in arrears or in advance. Let's assume that it is in arrears. It is annual payment of 6,000 for using the assets, which is in arrears. So the lease period is 5 years. Okay. It means that every year, at the end of every year, I will be what? Taking 6,000 from the lessee. Okay. So if the case should be like, I want to sell the asset to the lessee today, how much am I going to sell the assets? So what I'll do is that it is as if I have sold the asset to the lessee and we have agreed that he's going to be paying the money in installments, maybe at the end of every year, So since I'm saying that I'm not going to take the money today and he'll be paying it at the end of every year, I'll factor what we call time value of money. So assuming if I want to sell the asset to the lessee today and you want to pay, how much is he going to pay? You just present value all the rental payments. So you present value all the rental payments. So it's just like how we do it for the lessee, where we present value all the rental payments. The rental payments can be either be a variable or it can be a fixed amount. It can be a variable amount or fixed amount. So what we do is that we de-recognize the assets and we recognize what we call the lease receivables. Okay. It means that the lessor will be receiving some amount of money from the lessee. What do we use? What is the component of the lease receivables? We use the rental payment. The rental payment is one of them. So the rental payment can either be a fixed amount or variable amount, the combination of the two, fixed and variable. Okay. The fixed one is part of the rental payment will just be fixed no matter what. But part of it will be based on what? Inflation. So if the inflation rate is high, it means that that particular portion of the rental will also increase. So the rental payment can either be a fixed amount or it can be a variable amount. Part of the rentals must be based on what? Inflation rate. So if the inflation rate increases, it means that the rental will also, that portion will also increase. But if it decreases, it means that that portion will also what? Decrease. So the rental payment with present value it. We also look at maybe if there is any termination penalties. If there is any penalties or termination penalties, we look at that. If there is any options to, there can be a situation where at the end of the lease period, the lessee will say, oh, I will extend the agreement. So the lease period is 5 years. But the lessee is saying that at the end of the 5 years, I will extend the contract by additional 2 years. We only include this when the lessee is certain that he or she is going to exercise the option. If there is no assurance or there is no guarantee as to whether the lessee is going to exercise the options, we don't include the options in the calculation of our lease receivables. But if the options, there will be an amount. If you are going to extend it, it means that you are going to pay a certain amount. So if you are sure that you are going to exercise it, then we also include that. We also include that. Another one is what we call guaranteed or residual value. So they are saying that at the end of the lease period, the residual value, the amount that we are going to, or the scrap value of the asset is this amount. So that particular amount will be gotten at the end of the lease period. We want to find the today's value of the asset. So we present value. This can be a guaranteed or unguaranteed what? It can be a guaranteed or unguaranteed what? Residual value. The guaranteed one is the one that the lessee is saying that at the end of the useful life or at the end of the lease period, I'm going to pay this for the asset, which is the residual value. So the lessee is giving assurance to the lessor that I'm going to pay you this amount at the end of the lease period. The unguaranteed one is the one that the lessor is going to get from the what? From the market itself. So the residual value, we use both the guaranteed and unguaranteed for the lessor, because the lessor is going to get the two amounts. The lessee is going to give this, and the market itself is going to give this. So if we put the two together, that will be the residual value of the assets. All right. What will be the subsequent measurement? This is the initial measurement. What will be the subsequent measurement? Okay, let's take this one before I'll go to different one. There can be a difference here. If there is a difference, how do we go about it? Okay, if there is a difference, how do we go about it? Okay, so we are saying that the first one is to de-recognize the assets. So let's assume that the value of the asset is 20 million. Okay, and the receivables is 18 million. What is happening? The value of the asset, the carrying value of the asset is 20 million, and the lease receivables is 18 million. We are saying that we should remove the asset from the books and bring what? The lease receivables as current what? Assets. Some people can show it as a current asset or as non-current what? Assets. Okay, so the assets, the value of the asset is 20 million, and we have to remove the 20 million and now bring what? The lease receivables, because we have given the asset, or we have sold the asset to someone on credit, and the person is going to pay. So the person is owing us. All right. So we are taking these assets and we are bringing this amount. What is happening here? What is happening? Looking at the two figures, what is happening?
The rental is lower.
The rental is lower. So what are you having a gain or you are having a loss? All things being equal. You are having what? A loss.
A loss.
Okay. So that particular loss of 2 million will be sent to profit or loss. Okay. It's just as if the asset is 20 million and you have sold it for what? 18 million. You're making a loss. So if you want to de-recognize the asset, the difference between the carrying value of the asset and the lease receivables, if there is an increase or decrease, it should go to what? Profit or loss. This is if the company is using cost model. So if the company is using revaluation model, it means that the company must first revalue the asset before they de-recognize the asset. So maybe at the day they will give you a fair value of 22 million. So it means that you have to first revalue the asset. So you compare your 22 million to 20 million, you have a revaluation surplus of 2 million. Then you now come and de-recognize the what? The assets at 22 million. Compare 22 and 18. The loss will be what? Will be 4. But these 4, 2 of it will go to other comprehensive income and 2 of it will go to profit or loss. That is not a problem. So basically, this is how we go about this one. But how do we go about the lease receivables? How do we go about the lease receivables? You have to know that the rental payment and other issues are being present value to get the lease receivables. So at the end of every year, we have to what? Compound it. So at the end of every year, we have to compound it. So you have your lease receivables, you calculate your what? Your finance income, just like the way we calculate the finance cost. So the person is owing you, your money is with the person. So if you should go and put this money in the bank at the end of every year, you'll be getting 8%. So since the person wants to take the asset on credit, the two of you have agreed that at the end of every year, you are going to pay me interest of 8% on the amount. So at the beginning of every year, say 2021, assuming the lease liability, the asset lease liability, net receivables is 18 million. You are going to have your balance at the beginning, then you have your finance income. So you calculate a finance income of 8%, 0.08 times 18. Then this will be 18. You add it, then the person will pay some part of it. So the person will pay some amount of money of it, which will be, let's say, 6. Then you put a 6 here, like the way we do the normal lease. That is very simple. So subsequent measurements, the lease receivables will be amortized. It's just like a loan. Just like a loan, you have taken money from someone, and the person said that if I should put this money in the bank every year, they will be charging me, or they will be paying me interest of 8%. So since you want to take this money, it means that you'll be paying me interest of what? 8%. So you calculate your interest as finance income, and the person will pay part of the money that the person is owing you. So charge the interest, add it to the amount that the person will pay, then you subtract the amount that the person has paid, then you get the remaining amount. The finance income will go to profit or loss as finance income, or if you like, you can do it as other income. That is all about the Lessor accounting. We are going to pick 2 questions, 2 solid questions on that. 2 solid questions on that. So the document that I've shared with you, the first 2 questions are on Lessor accounting. So I'll go and pick my question and come in, put it here, and you also read the one from your document. Okay. The question that I shared, can you see question 1, 2 out of it? The one that I screenshot and put on the Telegram. I can see question 1, 2. Let me check. Hmm. Start over.
Hello.
All over. Start all over.
Okay. At the beginning of the current year, ending 30th April 2023, management of Akoma PLC leased a specialized equipment to Sophia for annual rental of 5 million Ghana cedis. The specialized plant has estimated useful life of 10 years, and the lease period is 8 years. The arrangement also requires Sophia to maintain and insure the equipment over the lease period. Sophia is also expected to make additional payment of 0.6 million Ghana cedis at the end of each year that production output exceeds a defined output. At 30th April 2023, Sophia production had exceeded this defined output target, and the additional payment was made accordingly to Akoma PLC. The open market value of the asset estimated at inception of the lease is 1.4 million Ghana cedis, of which 0.5 million Ghana cedis is guarantee by Sophia, okay. Both Akuma PLC and Sophia PLC incurred initial direct costs of 0.4 million Ghana cedis and 0.2 million Ghana cedis. Implicit interest rate in the lease is estimated at 8.98%. Required, in line with IFRS 16 leases, explain how Akuma would account for the above lease in its financial statement for the year ended 30th April 2023.
Okay, that is nice. So this one, which type of who are they asking us to do the entries for?
I think the lessor.
The lessor, okay. So the lessor. So what we know is that the lessor, this is a finance lease, isn't it?
Yeah.
Because the question even stated that Sophia is to maintain what and insure the equipment over the lease period. So since you are incurring the maintenance costs and insurance costs, it's as if you are the legitimate owner of the asset. So if this happens, it means that lessor must de-recognize the asset and recognize what we call the lease receivables. All right. So what is the rental payment? Let's get the issues one by one. So question one, let's get the rental payments. The rentals. How much is the rentals? Let me increase this one some more.
The rental payment is 5 million.
Okay. So the rentals. Let me give this one. Question one. So let's solve the question one. So the rentals is 5 million. How are they paying it? In advance or in arrears? Were you giving any clue about how the rentals will be paid? Is it at the end of every year or at the beginning of every year?
At the end of
every year.
Okay, 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 okay. So do you have any other payments that the lessee is going to make in relation to the asset? So we know that our rentals, which is the constant, you can, if you don't pay this amount, you cannot use the asset. So that one is a cost that you cannot avoid. If you want to use the asset, you cannot avoid that particular cost. Okay. The specialized plant has estimated useful life of 10 years and the lease period is what, 8 years. The arrangement also requires Sophia PLC to maintain and this. Okay. Okay. Sophia PLC is also expected to make additional payment of 0.6 million at the end of each year. That production output exceeds a defined output. What about this 6 million? Is the amount that is it a cost that Sophia cannot avoid? The 0.6 million. Is it a cost that Sophia cannot avoid as far as the lease is concerned? The cost, is it avoidable cost? The 0.6. Is it a compulsory payment that Sophia has to make before he or she uses the asset? The
No,
0.6.
It's not.
Okay.
it's not.
So Sophia can still use the asset, but can still avoid what the 0.6 because they are giving you what? A capacity. So Sophia can avoid that particular cost by what? Producing at what? At a capacity lower than the what? The budget or the agreed capacity. So the 0.6 is a cost that Sophia can avoid. So we are not going to include the 0.6 when we are calculating our lease what? Receivables. It's not compulsory payment that Sophia has to make if he or she wants to use the asset. They are just saying that if you are able to produce more than 30 million capacity, you are going to pay this. What if I'm producing at 25 million? I'm not going to pay that. So that 0.6 is just a cost. Whenever Sophia produces above the capacity, Sophia will pay that amount and turn it to profit or loss. So the 0.6 is not going to be part of the figures that we are going to use to calculate what the lease receivables. Okay, so that particular one is a cost that can be avoided. So we forget about that one. Let's move on. So an additional payment was made as soon as they made
But
this.
Linus,
Yes, senior.
yes, if you move further, it will tell you that Sophia PLC production had exceeded the defined output target.
Okay.
That is when you move forward when you are reading the question.
Yes.
Because after that first condition, but the additional information that was provided was that Sophia production had exceeded this defined. So
Okay.
can we still avoid it here?
They will pay this one, then the lessor will just pick it as finance income. That is all. But it will not be
Okay,
part
alright.
of you calculating the lease receivables because the 0.6, we don't know whether they are going to pay it next year.
Okay, all right.
We don't know whether they are going to pay it. But the 5 million, this amount will be paid throughout. So we can decide to
Yeah.
present value this amount. But 0.6
Alright.
million, it will be based on the capacity. So as at when they exceeded the capacity and they pay, the lessor will just take that amount as an income in the profit or loss. That is the end. But it will not be part
Alright.
of the calculation of the lease receivables. Okay.
Okay, all right. Thank you.
The open market value of the assets estimated at inception of the lease is 1.4 million, of which 0.5 million is guaranteed by Sophia. Both Akuma PLC and Sophia PLC incurred initial direct costs of 0.4 million and 0.2 million, respectively. Implicit interest rate in the lease is estimated at 8.98%. That is all. So what will be the next item that we are going to use for the calculation of the lease receivables? What will be the next item? What will be the next one that we are going to use? The open market value of the asset estimated at inception of the lease is 1.4 million, of which 4.5 million is guaranteed by Sophia. So what are we going to use? We are going to use what we call the residual value. The residual value is 1.4 million. Are you okay? All right. So the initial direct cost, Sophia will capitalize. Sophia will add.
Please,
Yes.
please, the residual value, why did you take the unguaranteed?
No, this is a total residual value. Part of it is unguaranteed, part of it is guaranteed. Whatever be the case, we use the two for the lessor. It's only the lessee that we use the guaranteed one.
Okay. Okay.
Okay. So the residual value is 1.4, but the lessee is saying that we are going to pay 0.5 out of it. But whatever be the case, the lessor is going to sell the asset for 1.4. But just as lessee is saying that I'm going to pay 0.5 out of that one. That is the only thing. So for the lessee, we use the guaranteed, but for the lessor, we use both. All right. So what do we do? This amount will be paid for 8 good years, and this amount will be taken at the end of the 8 years. So what we do is that we try to present value this amount. So we have, let's look at the calculation of the lease receivables. Let's look at the calculation of the lease receivables. So lease receivables. Okay. So what do? We have the years here. We have the cash flow. We have the discount factor. And we have the present value. So the years, we can use annuity. Okay. So this 5 million will be paid at the end of every year for 8 years. So we can have 1 to 8. We have 5 million. The discount factor is 8.98. Okay. Then at the end of the 8th year, we are going to have 1.4 million. So let's find this one. Let's use annuity for this annuity. All right. Can someone do that for me? Annuity for 8 years at 8.98%. Okay. How do we calculate annuity? Annuity is 1 minus into bracket 1 plus r exponent negative n divided by r. So the 1 minus into bracket 1 plus r. The r is the what? Is the rate, which is 0.0898. Then the n is the years, which is the 8. Then you do that. Someone should do that on the calculator and give me the answer. What are we getting? Or I should go and pick my own calculator. All right.
The figure, the discount factor, is it 0.89?
No, then that would be the last year. That would be for this one. For that one, it's supposed to be more than that. Which one do you use? You use the one over
I'm talking about the one you have written. Is it 8.98?
Yes, 8.98.
The discount factor.
Yeah. The interest rate is 8.98. Yeah.
Okay.
The annuity is 5.539.
5.539. Okay.
Yes.
So what will be the discount factor for in the 8th year? In the 8th year,
0.503.
0.503.
503.
Okay, let's just multiply. 5 times 5.593 and 0.503 times 1.4.
But the annuity one is 27.6. That's a 27.7.
Okay.
The second one is 11.2.
Are you sure?
Hey, sorry. 1.4. 0.70.
Okay. So we are having 28.4. Okay. So this 28.4 Okay.
This one we get 0.503.
0.503. Okay, that one is calculated as 1 over into brackets 1 plus r bracket closes exponent n. It's just like how we calculate a discount factor. The first one, what we are calculating is an annuity factor. The last one is just a one-time payment. Then we use what we call a discount factor. So it is 1 divided by into brackets 1 plus 0.0898 bracket closes exponent 8. What are you getting? You know what are you getting? Have you gotten the 0.503?
I got this and
Okay.
5.596.
5.596.
6.
The annuity factor,
Yes.
5.596. Okay, Charlie. Let me just go and pick my calculator and be confirming things. I mean, my calculator doesn't want to work. So, like, let's people confirm that one.
The first one is correct.
It's correct then.
Mm,
Okay.
5.539.
Okay, that is nice. My own the calculator doesn't want to work. So, but the issue is that we all know the answer. So if you have calculator, just points on it and get it. My own is not working. All right. Okay. So this is the at the beginning. This is our lease receivables. Okay. At the beginning of the year. At the beginning, which is first. At the beginning of the year, which is first. Is that going to be first? Okay. 1st May 2022. This is the lease receivables. This is what we are going to have. But we don't know the value of the asset. If we should know the value of the asset, we compare the value of the asset with this and find any difference. That difference will go to profit or loss. But we are not given that. But we were given other issues again. They say that both Akuma PLC and Sophia PLC incurred initial direct cost of 0.4 million and 0.2 million. We are doing this for what? Akuma PLC. So how are we going to treat the initial direct cost of Akuma PLC? How would the initial direct cost be treated? Don't add, when you're calculating the lease receivables, we are only looking for the amount that we are going to be receiving from the lessee and also receiving from the assets at the end of the useful life or the lease period of the assets. The initial direct cost, the lessee will not pay any part for, or the lessee will not pay any part to the lessor. So you can't include the initial direct cost as part of the lease receivables. All right. But the initial direct cost of 0.2 million, how are we going to go about it? The initial direct cost of 0.4 million, what are we going to do about it? So initial direct cost 0.4 million. Okay. What are we going to do about it? What do you think will be the appropriate treatment for the initial direct cost? Rob, what do you think you are going to do to the initial direct cost? The 0.4 million.
Are we going to expenses through the profit and loss?
Okay, you can also do that. You can also do that. But the appropriate one will be Yes, because the amount is 0.4 million, you can decide to expense it, but you are incurring this particular cost on what? On a contract that will last for what? 8 years, isn't it?
Yes.
Yes. So the appropriate method should be you spread it over what? The 8 years. You spread it over the 8 years. That would be the appropriate one, because this particular cost is incurred in relation to a contract that will last for 8 years. So you can amortize it over 8 years. That is all. All right. But let's look at the subsequent measurements or the subsequent treatment of the lease receivables. So the subsequent measurements, which is how it will be reported at the end of the year. So what we do is that we have our amortized table, which we have the years, we have the balance brought down or the opening balance, we have the interest, we have the rental payment, then we have the balance carried down. Okay, so the first year, which is the ending of the year now, our balance is what? 28.4. Our interest, we are paying this money in advance. So our rental that we are going to pay will be 5 million. So the people are currently owing us what? 28.4, and we are going to charge them interest of 8.98. So what will be the interest? What will be the interest? I'm getting 2.6. Is that correct?
Yes, 2.6.
Okay. So the person is there. Currently, you are expecting to receive 28.4 from the people, and you are charging them interest of what? 2.6. So the total amount that they are going to pay you will be the 28.4 plus the 2.6. Okay, that will give you 31. But they have paid what? 5 million out of that. So they are currently owing you 26 million. Okay. So in the profit or loss, we are going to have a finance income of 2.6. Maybe you have amortization of the initial direct.
Sir,
Yes, please.
please, I beg you. I can't see where you are now. My listen, you still have the old.
Oh, then it might be your network. I'm here.
Okay.
Okay. So still you can't see. Okay. So let's amortize the initial direct cost over 8. I'm getting 0. Shit.
Hello.
Yes, please.
Yeah. Hello.
Yes.
I'm trying to even read the table, the subsequent. What is it? Subsequent.
Measurement.
I can't see what you wrote. Measurement. Okay.
Okay.
So the table is years, balance brought forward. The
Interest.
the initial interest. Okay.
Okay.
Interest.
Okay.
Interest. Then the last one, the other one is
The rentals, the amount that you are paying.
rental. Okay.
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 Then we have the
Then the
balance.
last one is
Balance carried down.
balance carried down. Okay.
Okay. Or the closing balance. So amortization is 0.05. Okay.
Hello,
Yes, yeah.
Linus.
Yes, yeah.
Yeah, are they paying in advance or in arrears?
All things being equal, we assume that they are paying in arrears.
Okay.
Okay. So this is P&L. We have a finance income of 2.6. The amortization of the initial direct cost 0.4 divided by 8. We have 0.05. That will be an expense. Then if you go to statement of financial position, if you go to statement of financial position, what we do is,
Please go back small for me.
okay.
The under the P&L, the
Okay.
finance income 2.6, then amortization is 0.05.
Yes, please.
Right. Okay.
I hope you know how I got a 0.05.
No, not really. I
Eight.
think I
0.4 divided by 8.
0.4
divided by 8.
by 8.
Yes, please.
Okay.
So let's come to
The 26.
yes, please.
The closing balance or balance carried down 26.
Yes,
I don't know how you.
So is currently the amount that you are receiving from the people is 28.4. They are going to pay interest of 2.6. Then the total amount that you are going to receive will be 31 million, and they have paid 5 million. So at the end of every year, they are paying 5 million. So it will be 28.4 plus 2.6 minus 5. That will give you 26.
Thank you.
All right. Let's come to statement of financial position. Okay. For the statement of financial position, we have non-current assets. Okay. So the non-current assets, we have maybe the deferred initial cost. You can call it like that, deferred initial cost, which will be 0.35. Then you can also have the lease receivables, because this will be for remaining additional 7 years. So you can do it like that. That is all. But someone can also decide to show part of the lease receivables as current asset and non-current asset. There's no problem with that. So this is all that you are going to do for that particular question. All right. Let's see whether the question 2.
Please, how did you get the deferred initial cost?
Is the 0.4 divided the 0.4 minus the 0.05.
Okay. All right.
So 0.4 minus 0.05.
Sir,
Yes, yeah.
please, the defer initial costs.
Okay.
I don't understand it too. Like, does it mean that? Can you throw like a bit of light on it for me?
Okay. So the initial cost is 0.4, isn't it?
Yes.
Okay. But we have used 1 year already.
Yes.
So it means that the remaining ones will be consumed in the future. So we have deferred the consumption into the future. Or if you like, you can also name it an amortized deferred cost. An amortized initial cost, no problem.
Okay.
An amortized initial cost. So those are the one that you are yet to amortize. So this is all about this question. You can try the question 2 on your own. I will end the Zoom, and after 5 minutes, then you join again.
Now, Linus, make it 6 minutes. We're back. We want to pray and come back.
Okay. Then let me just make it maybe 10 minutes. All right.
10 minutes. So
Okay.
don't pray. So we have to pray.
Okay. All right.
Thank you.
All right.
Please pray for us all.
And you will do that. He's a man with a
Makes
good
that
heart.
so. Yes. And makes the action to me. He's a player warrior, so
So let's join after 10 minutes. All right.